Markets have opened mixed on this Thursday morning after U.S. stocks posted back-to-back gains on Tuesday and Wednesday. And the Trump administration helping to calm the markets by taking a softer tone earlier on China as well as the Federal Reserve. The White House is reportedly thinking about cutting tariffs on Chinese imports, some by more than half, to reduce tensions with Beijing. But stocks fell from their highs after a new report stating that Trump hadn't offered to do so unilaterally. And meanwhile, China claims that no negotiations have been held yet and is overhanging on the markets this morning. Now, Treasury Secretary Bessent saying a deal with China is possible, adding America first doesn't mean America alone. And China responded by saying it's open to talks, but not if it's being pressured. Well, Trump also clearing the air on the Fed, saying he's not planning to fire Fed Chair Jerome Powell despite earlier comments. Well, joining us at the New York Stock Exchange to weigh in is David Stryzewski, who's the CEO of Sound Planning Group. Well, good morning, David. So glad to have you here. So we've been seeing so much volatility as Q2 got underway, but why are we seeing such a price action here?
Well, you know, the price action is based on the fact that the first 100 days of this administration was a completely different direction than where we were headed before. And so now this new direction has, you know, some waves that are coming with it, and obviously that comes by the conversation of tariffs. You know, it's interesting. I think we'll probably see the catalyst that causes the market to turn around eventually here is going to be a deal with China, a Mar-a-Lago Accord or some version where it's not 145% and we can all live in this world in some way. It probably won't be zero, but it'll be something less and something more sustainable. And so all this volatility right now is coming because, you know what, we've had 2 years of amazing rates of return on the market, and now the market's sort of like, hey, are we overheated? Is it cooled down? And we're getting different data showing up here. So I think that we're going to see a little bit more volatility here for the next quarter or two, but ultimately we are headed in a better direction on the long term.
Well, David, you brought up the returns we saw for the major U.S. equity averages in 2024, 2023, double-digit percentage gains. And so far this year, Dow, Nasdaq, S&P 500, all in the red year to date. But I do want to get your take on an analogy that you have. Yeah. So the calm before the storm. And we know that given all the volatility, there's so many analogies out there. But why this?
Okay, so the calm before the storm is the moment where we need to prepare.
Okay.
So, you know, many people are nearing or entering retirement right now. And you ask the question, what should you be doing here today? You got to have your anchors in place, if we can use that, you know, and you want to stress test. By the way, that term stress testing comes from how much can your anchor take? How much can that chain take? And so dependent upon the storm, it determines the anchors that we want to ultimately have. And so I'm a little bit concerned right now with some of the traditional anchors in bonds today. And I think that we are likely to see potentially even, you know, some strategic bankruptcies in the market as liquidity is drying up right now. Rates are still too high. We've got some challenges here. And you know, it's an interesting deal. So we need to have our anchors in place, and we need to be understanding where are we going next.
Yeah, and I'm glad you brought up the bond market because it hasn't been behaving the way that it traditionally has. No. So what do investors out there do on Main Street who are looking at their portfolios and thinking diversification? What does that mean?
Well, you know, diversification typically means stocks and bonds. Understand, though, that bonds can lose money in 5 different ways. Okay, and so bonds can still work out. Short-term T-bills work great, but guess what? You're still paying short-term taxes on that, which is actually at your highest rate. So that may not be the best idea for everybody for every dollar. One of the anchors that I think is actually really important to understand right now is actually called an equity indexed annuity. This is an insurance contract, acts like a bond, none of the downside, reasonable rates of return on the upside, gives you the ability to have some peace at night. So it's a hedging strategy that gives you the ability to just kind of set it, have some peace, and know that you're going to be able to make it through some storms. I'd also say that it's important to note right now that we want to be focusing on real assets. Look at gold.
Absolutely.
Going to record highs right now, but what's been lagging is silver. 100 ounces of silver to 1 ounce of gold. I will do that deal every day of my life, Remy. Every day of my life, 101. So I think that you're going to see silver actually go parabolic here as we finish out or we continue into this year and we move into the next. But watch Bitcoin too.
Yeah.
I think that we're going above 100,000. There's going to be some pullbacks and different things along the way. But once the Fed jumps in to backstock the economy and we start getting to this lower rate environment, speculative assets go through the roof just like we saw yesterday. And I think that we're going to see probably, $250 on Bitcoin by our 250th anniversary, July 4th, 2026.
Yeah, I'm glad you brought up gold because earlier this week we saw it skyrocket to 3,500, a new record high, and we're pulling back slightly, but we're still above the 3,300 level, and that is significant. And Bitcoin has also recovered some key levels, seeing its highest level since March of this year, but it has yet to recover that 109,000 level. But the year is young, so we'll have to see what happens. So finally, I want to ask you, where are the safe havens and what do Americans out there need to keep in mind?
Well, the safe havens, I think, actually are things like Bitcoin. Think about what's happening around the world. If you live in a nation where inflation is a real problem, like 50 and 60%, like many nations around the world, what do? You got your paycheck. First thing you do, you go right in and you buy Bitcoin or you do something like that because you're going to get out of that currency that's deflating. Well, right now, the United States dollar has been very, very strong, and now it's going to be coming down in strength. Why? Because we need to buy, sell, and trade, and then our U.S. dollar needs to come down if we're going to be able to be competitive. So that was actually a part of the reason why we saw inflation even come down, because our U.S. dollar was buying more. So we're probably going to see some inflation going up. You need to buy things, put dollars into places that are going to be a little bit more of an inflation hedge. And one idea I'll share is metal miners are these companies that have been so beat up, and the price action that we've seen with gold has not been reflected in those miners. So they've got lower cost ounces in the ground that they can go and pick up. And my little secret here too would be look at the juniors. I think that the big guys are going to buy the juniors instead of going and doing their own exploration, because we got a drill baby drill moment, and you're going to be more looking to do activity as opposed to trying to figure out where to head it next.
Well, David, a lot of moving parts here, so thank you so much for weighing in on what we're seeing across the markets.
Pleasure's mine, Remy. Thank you.
Thank you so much.